Africa's startup funding is following a different direction in 2026. The first half of the year has produced a different investment pattern. Green technology, electric mobility, and energy infrastructure are attracting larger funding rounds than many of the sectors that previously dominated Africa's venture market. Spiro has become one of the clearest signals. Its latest financing adds to a funding cycle that has pushed Africa's e-mobility sector beyond $313 million in the first half of the year, more than the sector attracted during the whole of 2025. This is more than a larger funding round. It reflects a different allocation of capital. For years, venture investors concentrated on software platforms, digital services, and consumer applications. Today, larger pools of capital are moving toward businesses that own infrastructure, reduce operating costs, and build physical assets with measurable economic value. Electric mobility is competing on economics as much as technology. Lower operating costs, battery swapping networks, and tangible infrastructure are giving investors a different way to assess long-term returns and investment risk. Development finance institutions are moving in the same direction. The International Finance Corporation and other institutional investors continue expanding support for climate infrastructure, electric mobility, and productive technologies across African markets. Capital is beginning to reward businesses that solve structural economic constraints rather than digital convenience alone. Capital has already changed direction. The next measure is whether that investment builds manufacturing, battery supply chains, local production, and productive industries across Africa. That will determine whether today's funding cycle becomes tomorrow's industrial growth.